Welcome back to my channel. This is a vlog where I document my trading experience. I'm not a financial advisor. This is not financial advice. I just take the methodology and theories established by Thomas Bulkowski and apply them to AMC stock. And I trade on that information, and I'm doing pretty good. So I plug this book every video, Thomas Bulkowski, Trading Basics. This is the place to start, in my opinion, if you want to learn about trading. So, I see a lot of people online, like on Reddit and YouTube, not making the best technical analysis, and it just irritates me. There are three aspects to technical analysis that are fundamental to the entire forecasting method. And those three things are price range, time frame, and then chart patterns, okay? You need to consider all three things before you come up with a forecast. So if you're taking a portion of a chart and you're copying it and then you're pasting it near another part of the chart that looks similar and then stretching the price range to make it match and then elongating or shortening the time period to make it match, all right, to make your chart pattern, you're not doing TA, all right? So let's stick to the ideas that have been tested, that are scientific. Let's stick to sources from industry experts like Bulkowski and see what happens. And that's where I am at. I do trade the upside and the downside of the market. I don't just buy and hodl, right? I buy, I sell, I buy calls, I sell calls, I buy puts, I sell puts. I do all of those things because you need to take advantage of all of the instruments at your disposal to be able to trade successfully. So that's who I am, that's what I'm doing. Let's break it down. I want to start with the weekly charts. This is my overall thesis that the double bottom set in 2020 has been in play even until today. And that might surprise people. It's really popular now to look at this chart and say, well, you got the double bottom, a flag, and a flag. But that doesn't work. That doesn't work. If you're saying flag, who or what defines what a flag is? Does anyone know? Or is this all just people speaking? So Bulkowski is a known industry expert. This is the guy who has done extensive research over decades and thousands of stocks and thousands of charts patterns. And this is the guy who is defining what a flag is and is not. Okay? These patterns are too long to be flags. If you're taking that flagpole and you're applying that to the upside as your price target, that's not correct. That's just not how it works. So this is what I've done. Let me start. I'm going to give you the quick and skinny. So this double bottom formed and was confirmed when the price rose above this purple confirmation line where my cursor is currently hovering. And that's at around the $5 mark. So if you were to take this peak and this valley, or better yet, not that valley, but the next valley because it's lower, and use these 2 points with the confirmation level to make a price target, that level is actually somewhere up here, right? In this wonderful base level from which the price jumped. And I'm not showing that because it's too confusing. It's just, and it's not as relevant to what's currently going on. So if you take the highest peak from the double bottom and the lowest valley and use that same confirmation line, the price target is much higher, okay? It's up here at 33.32. And what's interesting about this level is that this appears to be the new floor. And that would suggest that the price run up has only just been confirmed. It was a big deal when the price fell to that level and held. That confirmed that the run was solid. This is the new price. 33 plus. So it's all tied together. It's not 1, 2, and 3 chart patterns. This is a double bottom with a handle, the run to the target, and then a price consolidation. And that price consolidation, I believe, is taking the form of a rising wedge. I'm going to go into the daily charts now to talk about that daily or that falling wedge. And that's not even in my dailies. I gotta keep it on this time frame. So let's just zoom in on it then. Here we go. Now, the 3 points I'm using are the very top, the very peak, and then you got one here, and then this down here. This is my 3rd point from my wedge. You might ask, why am I using that particular touch point? And that's because I believe this breakout, this was a false breakout, and this is a bearish candle. This is what's called a throwback. Okay, that's a technical term by Bulkowski to describe when a chart pattern appears to make its breakout and then fails. It doesn't mean it's over. It might hurt the overall performance of the breakout when it does happen, but this is a common experience in the charting world. So this was a throwback, and this price, it came almost back down to the target for that previous double bottom, the new floor, which is and it's almost like at the intersection of the falling wedge and that price that the bull stepped in, the buyer stepped in, and the price started to rise again. You'll see this candle. This is this week. It's not looking very bullish, is it? But I'm not too worried about that because AMC is full of surprises. Now I'm going to zoom in and change my drawing set and talk about what's going on the daily. That's not going to look good until I change the time frame and then zoom back in. So here we go. There it is. This move from 52.79 down to 33.74, I considered this to be a measured move down, okay? And shorts tend to enter these positions, or at least Bulkowski recommends shorts enter those positions at about here on the bounce from the initial drop. And the shorts would have made great money there, right? So I think what's important to realize is that this particular level where shorts would enter hasn't really acted as support until today. The price fell, came up, rejected off that level, dropped, came up, rejected, right? And then we saw this pennant form. And I thought about considering this a pennant at the time, but I just didn't have the conviction to see it that way. But now in retrospect, it makes a lot of sense. The measured move down was the flagpole, and this consolidation was a pennant. And then the pennant broke out on pretty much the day and at the level it was supposed to. Like, you can't make that up. That's just so picture perfect. And you see my touch points here. 1, 2, 3. And then 1, 2, and then the third one would be like the breakout candle. So there's plenty of touch points. This is good. And the time frame's correct. It's not a flag, okay? It's a pennant. So here we go. Let's pull up the thing on pennants by Bulkowski. This is Bulkowski's website, thepatternSite.com, and this is the source material for my price targets and the methodology I use. It's all here. So when I'm talking about price ranges, time frames, and chart patterns, a lot of those 3 things come into play here when you're trying to identify the patterns. So there are identification guidelines, okay? So pennants are short, 3 weeks long or less. Patterns longer than that are symmetrical triangles, rising or falling wedges. Okay, so that's what I'm talking about when I'm talking about time frames. If a pennant can't be more than 3 weeks, then January to June was not a pennant or a flag because they have similar time frames. So, okay, moving on. We have some trading tips by Bulkowski, and this is how we come up with price targets, right? He says compute the height from the start of the price swing, point A, and there's a little graphic on the right here, you can see point A, in the measure rule figure to the right, to the end of the price swing, B, and then multiply it by the above percentage beating price target, and he has those statistics up here, right? Here's our percentage beating price target. For upside, it's 35%. All right? And you add that on the upward breakouts to the bottom of the pennant, which is point C. And when I do that, you will be amazed to see how close this target is to where the price rejected. So the target was 42.78. The top of this green the close of this green candle is 43.03. The open of this candle is 42.96. And the level that we're looking for was 42.78. We're within a quarter. So retroactively, you can go and see that this methodology fit like a glove. And that's not a coincidence. The last couple of days I've been talking about this gap resistance too. The gaps act as resistance, and we saw that picture perfect. We saw the price reject yesterday, move up into that zone and just reject, come down. And today was somewhat peculiar. We did not see a big confirming move, a big fall down. Today, the price was supported at about that level where the shorts come in. Isn't that interesting? If you ask me, there could be some shorts that are getting out of the red. They shorted here. They want to see it go down. It came up. Oh no! That's threatening. This candle fills the gap. So the gap is now filled. The price has come down. It sounds like a good time to get out of your short position. If you were short, that's just what I would do. So this doesn't look bullish, right? It doesn't look bullish, but I am secretly very bullish. And a big reason for that is, and I'll zoom in on it to make it more clear, these retracement levels. The price broke out from the pennant from the very tip, ran, hit the first level of resistance, which is fine. It filled the gap, which is good, and then it only retraced. So here I have a Fibonacci retracement drawn from the bottom of this green candle to the top of this red candle. And on the right hand side, you'll see the percentages listed. So this price retraced to 50%. You know, historically, that's a great place for retracements to stop. So if this big move up retraced, that doesn't mean that the move is over. In fact, that pennant is acting somewhat as a reversal pattern. You know, bigger picture, like I was saying, I think, or maybe I haven't said this yet, but this falling wedge is forming into an ugly double bottom. I'll go back to my default and I'll zoom back out to the week time frame so you can get a better view of what that looks like. Now you can see this rounding action right here. This false breakout and the throwback, this is what forms the middle peak of our ugly double bottom. Now I say ugly double bottom because an ugly double bottom is different than a double bottom. And there's different kinds of double bottoms. And that's another thing. If you're going to be doing technical analysis, technically, the way things are technically different is important. So in an ugly double bottom, the price target is different. Let me show. Let me zoom out a little more. Maybe I just need to do this. So this purple line up here, this is the next ugly double bottom target. This is my next target. You'll see the falling wedge target is just below it. So in all honesty, I wouldn't be surprised at all to see something like this, right? Where we get the next move up, we grind until we hit this upward channel, this rising channel, which I'm sure you have seen if you're watching this and you're not me. And then we see the next big price explosion, right? Like I really think this is what I think is going to happen. Now the flip side is horrific, right? The flip side is a return into the wedge, right? Maybe we bounce off of it, reject off of here, come down, and who knows? Maybe we break down all the way back down to $10, okay? These are the two scenarios. Every forecast needs to have a bullish and a bearish scenario. It's not about guessing which way the price is going to move. It's about forecasting where the price will land in a bullish or bearish or a neutral scenario, and having trades that will make you money regardless. You can make money as the market goes down. You can make money as the market goes up. You can make money as the market goes sideways, and that's where I'm at right now. And I did take the opportunity today to close one of my open positions. If you've watched my other videos, you know that I have 4 contracts right now. And I was recently able to close the call that I sold and maintain a profit margin. And what that does is it allows the call that I purchased to be essentially cost-free to me. And if we do see a run Thursday and Friday, then I will be able to just make money on that call, write it all the way up, and sell it. And that's what I'm hoping for. If that doesn't happen, I still make money. It's a nominal amount of money, mind you. But what I've done is I've provided the opportunity for me to make incredible upside at zero risk. So that is the ugly double bottom that I'm hoping to see. And the reason why I think it's going to play out like this is because of all the hype, right? I think there's a lot of people that think this thing is just going to repeat itself, and I don't think so. I think the stepping action is correct. I just don't think that there is a double bottom as powerful as the one as we saw in 2020. Okay, I lost my log scale, but basically, I don't think that that same level of momentum exists. Not unless shorts decide to cover, which they haven't. And remember, a short squeeze won't happen until shorts decide to cover. Shorts decide when the short squeeze is. So that's not something to bet on. It's not. You shouldn't bet on it. You should be ready for big bullish price movements and maybe be in a position where MOAS will benefit you should it happen when it happens. But buying calls and just buying calls, letting them expire worthless week after week is not the answer. But if you are going to be using calls, you can use options contracts to negate risk and open up the opportunity to make money on those price runs. And that's where I am at right now. So eventually, there will be a big price movement up or down. Regardless of which way it goes, I will be in a position to make money on that move. And all the while, I'll have weekly options every week, right? That will make me money. And when the big move comes, I'll just cut half the trade and ride the wave, and it's gonna be incredible. So I want to document that, and then say I told you so, and then kind of wag my finger and say, "Don't be stupid." But again, we'll see how it pans out. I'm obviously very optimistic. So I wanted to look at the daily chart really quick, and maybe we'll even do it in the 5-day, 15-minute time frame. And I want to go over the RSI. Oh, it doesn't show well. Go back to the 5-day, 5-minute. This is what I'm talking about. So you'll see the run we've had the last couple of days. It was great. It was great. Up, 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 up. And then it kind of peters out. Gonna go to intraday patterns here. So price comes up, it comes down, right? Bounces a little bit, comes down again, and then this was the rest of the day today. I'm kind of thinking that we're gonna see a double bottom form here too. Now charting on a daily on the minute time frame like this is pretty worthless. Honestly, I talk about time frames. The smaller, the shorter the pattern is, the less reliable it is. So I'm wary. But because we saw this peak come retrace nicely, nice even controlled retrace, and on like no volume, like the volume today was, I mean, it's phenomenally low. We just need to go look at that. Right? So let me pull the volume up so you can see it better. Look at how low our volume was today. This line here, this is the average. And I believe that's not 50 periods, which is days. And then it has a series. But you can see volume has been dropping, and we've been trading below volume for a long time. So I think this is a low volume dip. Low volume dip, nice even retrace, no reason to panic. I want to say that we're going to see this bounce up to this intraday double bottom target, 43.89. That would be great. We will also need to see a breakout, though, to continue. And this is why I closed my open call. Because basically, the price can rise all the way to $52.73 before hitting major resistance. There is a retracement level in around the $45 mark, and that is going to be a level to overcome as well. But should we see in the last 2 trading days of this week a move upward, as is suggested by this push and retrace, if this happens like this, I think that there's going to be an explosion of demand. There's going to be all sorts of hype. You're going to have people going crazy. They're going to say it's the start of the MOAS. It's going to be nuts. So I am way more cautious about losing upside gains than I am downside. So that's where I'm at currently. If you've been following my channel, I do have a custom RSI indicator that I've been using to buy and sell, and I've been testing it. It's pretty good. I did find a critical error in how I've been doing the calculation though, so I'm gonna have to start over. At least I was only on day 4 of testing it, so you know, silver linings. But nonetheless, that's where I am. I'm bullish. I think we just came out of a pennant, pushing upward. I think that gap zone of resistance is about to get obliterated, and I'm feeling bullish. On the flip side, the price moves sideways or comes down. It doesn't matter. I'm here for the big waves, and I am ready to catch it whenever it decides to happen.